Hey everybody, this is Jose Blasco. We are about to start. Can I have a quick confirmation that you guys hear me well? A quick hello on the chat box would do. That would be my indication that I know you hear me, and therefore you typed hello. And that way we can start on time. That would be appreciated, everybody. In the meantime, I will turn on my video stream as well so I can say hi as always, like every time, from the bottom right corner. Everybody, how are you, my friends? Here we go. It's time to get started. So we are now live. Thank you so much, Luis, Mark, everyone, for that hello. Welcome to the session, everybody. Today is January 21st, 2021. Lots of twos and ones with a zero in between, and that makes it for a good session, isn't it? Let's get started with our session related to options trading. Options give you options, as is suggested by the title of this session, and therefore we like to exploit the various possibilities when it comes to options trading, trading directional, trading non-directional, and so on. Depending on what the market has to offer, we will certainly be positioning ourselves in a way to take advantage of that. Okay. Before we begin, of course, I would like you to read the financial disclaimer on the top portion of the screen. I am highlighting it with a blue background so you guys know exactly what I'm talking about, and I'm pointing at it so you can read it carefully. Every word is important. Please read it all. It's not that long, and that way you are well informed when it comes to the financial risks associated to trading, etc., etc., etc. Okay. Very good, everybody. So the session is now officially introduced. So it's time to jump on the charts and begin our session. Okay, good. So what are we gonna do? So let me load the chart of the S&P first. So what are we gonna do? Well, as always, we kind of break the session in three parts, isn't it? So one session is for us to look at the market and understand what's happening. Second session is to go ahead and look at the current opportunities that we may have running. So if there is any lesson to be learned, if there is any advice to be given when it comes to trade management or something like that. And by the way, when I use the term trading advice, I mean it from the basic definition of the English dictionary, meaning that I show you what are the things that you could do. Certainly, trading decisions are yours. Real money, paper money, larger size, smaller size. Okay, so don't get me wrong in this way. Okay, and apart from looking at the markets and looking at the current opportunities that we have running, then we jump into the last portion of the session, which is the most important, normally the most appreciated, which is when we go ahead and we look at new market opportunities. How are you, Christian? Good to see you. And if those opportunities are meeting our rules, actually, it's even more exciting because then we can place an order and execute the trade if we choose to, isn't it? So that's ideal because like all skills we learn through practice, and I would like it. That's what I like the most when I run the sessions for you guys. I would like it that the market is kind to us in the sense that the opportunity is available, meet our rules, and therefore we can have as much practice as possible. Okay. Last week when we met was not a super active week. While the markets are moving nicely in both directions, to be honest, it was not so active when it comes to the amount of opportunities that we found. We'll see how it's going to be today. I'm going to start talking about the market right now, so we are about to see it. Okay. Also, I wanted to say that some of you have been sending emails with questions, and I directed some of the questions to the YouTube channel because sometimes you guys ask very good questions. They are so good that it's basically impossible to respond to them in a, let's call it a short email, or even if it was a lengthy one. There are certain things that cannot just explain just with a piece of written text. Okay, so if you guys have any question and you want to ask here, this is a good place to ask. I'll find the time to be able to give you an answer, and I always like to illustrate those answers with real-time examples, with charts, with different what-if scenarios, so you guys get like a complete answer. Okay, because there are certain things where I personally am not too keen to give you, let's call it, incomplete or partial answers, which is sometimes the only thing that could be done in an email because it's an email, right? So, but here in the YouTube channel, we can take a bit more time and be more visual, and of course the microphone helps for me to phrase that answer or explanation, and that hopefully is what helps you the most. Okay, cool. Okay, so looking at the S&P. Okay, so when we look at the S&P, and we start looking at the climate, okay, so I'm looking at SPY, the ETF that tracks the S&P, isn't it? So what do we have? We have a confirmed climate. In the prior sessions, we were talking about how the climate was likely going to exhaust, and notice what we had, okay? We had a little bit of a pause, and next thing you know, we are back in the game with a confirmed climate. So this is candle number 2 of what statistics suggest is going to be 10 candles up. So in other words, to see the market keep going higher and keep making all-times high for another week or two will not be a surprise, okay? At the same time, stepping into all-times high territory, it's always a bit tricky in the sense that, all-times high is indeed high. So many people, including large market participants, they may choose to take profits, and that may create corrections that are sometimes severe, which then provide good opportunities to re-enter, okay? So it's kind of like playing the game in a smart way to take advantage, okay? But certainly not with a bias, okay? Like yesterday, of course, it was an important day in the US, with a new president and everything else. So now you may be biased in one way or another. It really doesn't matter. The point is not to be biased, okay? And how you can be not biased, just look at stats, okay? Are they magic? No. Do they fail sometimes? Of course, they're stats. Okay? Even 99% means that you still got 1%, it could be different than what you expect. So stats are stats, but it's something objective, it's measurable, it adds odds in your favor, and that way, it's very easy to put emotions and, the pride associated with being right or wrong, you put all of these away, because now if something is to blame it on AutoClimate. That's it. Is that making sense? So that will create peace of mind for you as a trader, and allow you to execute trades more efficiently, okay? What else? Well, UFOs, you can see here a UFO was formed, actually that was yesterday, and notice how that has been tested, okay? And the moment it's been tested, price continued moving higher, again in that all-times high territory. So again, we are likely going to see the market continue in that direction. So if we look at the VIX, which is the implied volatility index, notice that now we are talking about 2171. Funnily enough, notice how the market is going up, but the VIX is going up too. Okay, this is normally not the case. When the market is going up, normally the VIX will go down. Normally, notice I said normally a few times. Why? Because normally means not always. And this is one of those cases where we have a divergence. And this increase in the price of options, it's basically telling you that there may be people concerned about what I just explained, that we are stepping into all-times high. Why, if there is a correction, let's buy some protective puts. Let's put together some trade opportunities that consist of buying options, either because you think it's going to the moon or because you think it's going to crash. People are buying calls, people are buying puts, and therefore the prices of options are rising because of the normal effect when there is more buyers than sellers for something, so prices go up, isn't it? So we can see that here, and this together with the market condition we have, together with what we have here, like it happened in recent times very, very often, it's pointing at the fact that we're going to start the session with non-directional trades, kind of iron condor type of opportunities. Why? Because options are not that cheap, and when you look at opportunities to go long, we only got 4. It's not like there are not more than 4. Okay, there are more stocks that are probably good opportunities to speculate and go long. But if you were to do it with options, the majority of those stocks have options that are already expensive. Probably they started making all-times high a bit earlier, or maybe they had, let's call it fundamental reasons or whatever reasons, to potentially start making all-times high, and a lot of options buyers started buying them, and therefore they are expensive right now. So if you were to do the trade now, it doesn't put you at an advantage to buy options that are expensive. It's a bad beginning. You want to buy options that are cheap. So when options are cheap, what do you want to do? Well, instead of doing debit strategies, which is buy options, buy calls or buy puts, buy calls when you want to make profits on the way up, buy puts when you want to make profits on the way down. So, well, if they're expensive, you don't do debits, you don't buy them. What you do is that you do credits, you sell them and collect premium, which another way to say that is credit options strategies, okay? And in the world of credit, you basically have 3 types, which is the purely non-directional, where we expect the market to stay sideways, the ones that are directional, let me rephrase that, the ones that are neutral with a little bit of bias to the upside, okay, and the ones that are a little bit neutral with a little bit of a bias to the downside, okay? So those are the 3, and the ones that normally pay the best are the ones that are purely non-directional, because you're going to be selling calls and puts in both sides, and therefore you get paid double. Where if you do the directional, the neutral up, sorry, not sure why I keep saying directional. So those opportunities will have you basically be a seller of puts and spreads and everything else, but basically you're going to be selling puts, not calls. Where if you do neutral short, you're going to be selling calls, not puts. And basically what all of this does is it gets you collecting, let's say, half of the premium. It's not exactly like that, but if you sell calls and puts, it's kind of double. If you sell only calls or only puts, it's kind of half. So basically, the neutral opportunities normally will have you be in a situation where it's more difficult to make a profit, where the non-directional, pure non-directional, it's normally more convenient, especially from a risk to reward point of view, because you collect, again, double the premium, which is not exactly double, but kind of, okay? Good. So we're going to start from these opportunities in a second, okay? Before we go there, I'm going to look at TIM and UPS, okay? So TIM is an opportunity that we reviewed already last week, and we said it was extremely likely that it was going to be fully profitable. That was last Thursday when we met. The price of TIM was here, right? And we said, okay, so one more day to go. If we stay in the purple area and we reach January 15, which was last Friday, and we did. Okay, we were in the purple area when we reached January 15 at the closing time on Friday. So then this Aaron Condo will be fully profitable. Okay, and this is what happened with TIM. So I mean, we knew that already because of the last week review. So nothing new. So I'll get rid of TIM unless you guys have any question. TIM is done. And the one trade that we put together last week, which if you recall, I was not positive the trade would give us a fill or not. Okay, I remember we were asking 40 cents for the trade to be executed. The current price that we saw was 30, I think it was 35 cents, yes, because our minimum was 37.5 cents, 38 cents, and it was 35. So I remember telling you, hey, go ahead and ask 40 cents, and you may get filled or you may not get filled before the end of the day. So in that day, really, the market stayed more or less in the same place, and it would, in my mind, it would have been difficult, okay, for you to get a feel on this trade. Okay, some of you may have had, and feel free to share if you feel comfortable sharing. Feel free to share in the chat box if you got filled for 40 cents or more. I'd like to know that. Certainly, the next day with this massive drop, definitely you could have got way more premium. Okay, but also if you had done the trade the next day, just like by doing the trade at this moment in time, the equal distance above and below are, sorry for that, the equal distance above and below are those dotted lines, okay, which are, as I just said, equal distance. If you had done it the next day, okay, and let's say you did it right at the open, so that was the opening price. So now, of course, the dotted line above is way further than the dotted line below, which, implies that probably the strikes to be used were not the 172 and the 157. Maybe you did a trade with the 155 or something like that, whatever. It was a different trade. Okay, it's not the day after this trade would not be valid. So it's either you got filled, Mark, you did not get filled. Okay, so that was my expectation, because the price movement was not that great, and I was thinking that probably 40 cents would not be doable, as I see the price movement. Of course, after the fact, we placed the order just in case, but then the movement did not create the 40 cents. Okay, thanks for sharing, Mark. So anyway, so this trade was not executed, but in any case, I'm just gonna leave it there and we're gonna review it. Notice that we went slightly beyond what probabilities were suggesting. We went slightly beyond the UFOs, but now guess what? We got more UFOs coming up, and then tomorrow is the expiration date. So, let's say you had been able to get into this trade. So certainly you would not be too comfortable when that happened, and we went away or beyond the statistical range and the UFOs. But now, given the fact that we got UFOs and we got only one day to go, this trade is likely to end up going to be profitable completely, okay? Fully profitable. In any case, we had sessions in the past where we talked about what I call damage control mode, and certainly not today because I want to get into planning trades now, but another time we can certainly talk a little bit about, trade, let me say that again, damage control mode. I was getting confused in my head because many people in the industry, well, not really many people, but a few people in the industry like to call what I call damage control mode. They like to call it repairing a trade. Okay, and that gives you the false impression that no matter what, you repair the trade and you end up in a profit. It's not true. You cannot just guarantee a reparation of a trade if the market went against you. Okay, you could mitigate the problem, and that's why I prefer to call it damage control mode, which basically gets you in a position where you still have an opportunity for a profit, and now if you were to lose, you lose way less than what you will lose if you were to do nothing. So that's damage control, and we have recordings on the channel. If you haven't seen it, check the sharpening playlist. Okay, and you will see what I'm talking about, and you can certainly watch those videos. Just search in the YouTube channel for damage control. Okay, cool. Okay, so with all of this said, I used 15 minutes of our time, so we got 30 minutes in front of us to look for market opportunities. Okay, and I'm gonna start with the non-directional trades. As I said, the one on top of the list is IBM. Notice how I'm sorting the prices of the stocks from the most expensive on the top to the cheapest on the bottom. Okay, why am I doing this? Well, because we are about to sell options and collect premium. And what do you want to collect? Little premium or a great amount of premium? Well, you want to collect a great amount of premium. And certainly options derive their value from multiple parameters, not only from the price of the stock, but also options are known as derivative contracts, meaning that they derive their value from the price of the stock. So if you were to keep everything else equal, the higher the price of the stock, the higher the price of the option, and when you sell it, you get paid more. So in order to kind of save my time, or at least start from a place that makes sense, I'm just sorting the prices of the stocks from more expensive on the top to cheaper below. So that way I start with stocks that are likely going to give me, at least from that very simplistic approach to options pricing, stocks that are likely going to give me a bit more premium, and hopefully I waste less of my time, because you don't want to start with the stocks that probably are no go. You want to start with the stocks that are probably go, so you get the trades in sooner, and then you go to the gym. Okay, and you don't need to stay in front of the screen anymore. Mark, could you expand the scanner to full screen with? Yeah, absolutely. So here we go. This is what you wanted, Mark. You mean the results of the scanner, or you wanted to show the parameters of the scanner? Okay. I have a more principled question. Why raise 2.5 to only collect 40 cents? Isn't that bad risk to reward ratio? Yes, it's terrible reward to risk ratio, but the probability is high enough to justify it. Okay. So there are three variables that you need to keep in mind when you trade. So if your methodology, let's say you have a methodology which is, the parameters, got it. So let's say you have a methodology which is very, very weak. Okay, let me zoom this in for Mark, so Mark can take a screenshot in the meantime. So let's say you have a methodology which is very, very weak, okay, with a win-loss ratio which is like 20%. Well, that means that 80% of the times you lose. So the only way to make money overall is to have a reward to risk ratio which is at least 4, 5 to 1. And now it's going to be a painful methodology to trade, because 80% of the times you'll collect losses, but the moment you get those profits, they're going to be so humongous that in the end, after 100 trades, after 1 month, 2 months, 6 months of trading, so you are in the green, and it could actually be nice, even though you do need such a special trading psychology and mindset to be happy trading a methodology where 80% of the times you lose. Okay, not everybody can do that. Okay, and it's not necessarily wrong. Okay, as long as you do make sure that every time you profit is like 5 to 1, 6 to 1, whatever, huge profits. Okay, the other extreme, okay, is what you could do with option selling. Okay, with option selling, the methodologies are giving you profits way more often. So then what can you do? Well, you could afford to go ahead and have very weak reward to risk ratios, okay, and still be okay, because most of your trades profit. So when one of the trades loses, then that's a problem, but most of the trades profit, and then you're fine. And then, of course, when you add damage control to the equation, then you start the trade with a terrible reward to risk ratio, but then when you get in trouble, you do damage control, and that terrible reward to risk ratio gets very much bettered, and then the trade makes a lot more sense. Okay, again, it does require some trade management, but that's how you do it. Okay, this is the pros and the cons of selling options. Okay, like every option strategy or every trading strategy, no matter what you trade, there is always pros and cons. Okay, so the beauty of doing an iron condor, for example, is that right now, if we find one, you take it. There is no waiting time or anything like that. That's a great advantage, something I personally appreciate. Other trades, for example, let's say you want to buy a stock, but you need to wait for the stock to drop to a certain point. Well, I just said it. You have to wait. You are waiting for the stock to come to the price at which you want to buy, which is perfectly fine. Actually, is the way to do it. But you have to wait. And it may not even come to you. So you waited for nothing, right? So you got pros and you got cons. Okay, you may have higher probability, better reward to risk ratio, but a lot of wasted time in the process, right? So if you do iron condors, there is no wasted time. You find the trade, you execute, done. Okay, then probability is much higher, so then you can afford worse reward to risk ratio and still be okay. Now, on top of all of this, I'm adding a lot here, and hopefully this is making sense, Christian and everyone. So remember, when we put together iron condors here in the sessions, it doesn't mean that I'm telling you go ahead and for the rest of your life trade iron condors and that's the only thing you do. That is absolutely not the case. We always talk about diversified portfolios where some of your positions are pointing to the upside and you are directional long. Some of your positions are pointing to the downside and you are directional short. Now, if you are doing that with options, typically you use debit strategies. Debit strategies typically lose time decay. So what do? You plug a few iron condors in between, because not only they are a source of some profits, even if the reward to risk ratio is weak at the beginning, but on top of that, they are an offset for the time decay you suffer on your directional trades. Those iron condors pay you time decay. So you are kind of now removing some of the disadvantage of options trading when you buy options, which is the fact that options lose value as time passes. Okay, and again, if you combine it all together in one portfolio, so again, you have all these different moving parts working for you. Okay, but you do need to understand every one of those moving parts separately, so when you combine them, you don't go crazy, because certainly managing a portfolio with options, it's quite professional. Okay, it's not like you bought 10 stocks and you are long 10 stocks and you're just collecting dividends, you have no stops, and you're hoping for the best. This is what most investors would do, isn't it? Well, here we are doing something much more professional. It does require other possibilities, and definitely when doing those iron condors, we do accept weaker parameters for reward to risk ratio because of everything I just said. Okay. By the way, another thing that you guys need to know, and feel free to comment as I say it, because this may be counterintuitive thought, okay, and I may challenge a little bit some of you with the way you think about trading, and it's okay if we don't agree, guys, okay, because the sky is the limit. There are a million ways on how to trade, and as long as you are professional, discipline, you have a plan, and you have an edge, and you follow and you manage the risk and everything else, and you manage your emotions, there are many ways on how to trade, okay. But again, I just want to challenge a thought there, which is the fact that most trading books, most trading courses, most trading everything would always advise that when you trade, the minimum reward to ratio you should execute is 3-to-1 or 2-to-1. That 2-to-1 or 3-to-1 is kind of like classical in the industry, and everybody talks about it. And that was, let's call it doable, or even I would say quite doable. If you look at the markets back in the 60s, the 70s, things like that, piece of cake. The moment we got computers in the game doing high frequency trading, many times those very far targets are close to a utopia. Okay, actually, one of the things that I love about all times high is that there is no reference above price, and now you have market opportunities that are possibly going to give you very powerful profits, like we have done earlier in the year. Okay, or I should say last year. But again, just attempting that every one of your trades is going to be like 3-to-1, 5-to-1, 10-to-1. It's great on paper, but the reality is that when you start trading, it's very unlikely. Okay, very unlikely. So just keep all of this in mind, my friends. Long explanation. I diverted from what I'm supposed to be doing, but that was a very good question, Christian. So hopefully this makes sense. Cool. So Mark, parameters. Just click the full screen on the scanner, then parameters display in the watch list. Oh, you mean this? Got you. I got you now. You have been crazy since I started trading. Well, a little crazy is good, makes us more human, okay? But certainly I'm using or trying to use a bit of humor here. Again, we gotta manage those emotions, okay? And we talked about that before, Mark, and I know you know what I mean, and everyone. So anyway, back into options trading. Good. IBM. Okay. So no go. Why? Because when looking at the earnings for IBM, they are actually today. Okay. So we cannot do a trade where earnings may end up, playing bad games with us. Okay. So we're gonna move to NVAX. Okay. We got pending data, so I'm just gonna wait. In the meantime, while I'm waiting, I'm just gonna zoom in on the earnings. So in this case, earnings are in March. So if earnings were to be in March, I would be delighted to do a trade on NVAX because we have plenty of Fridays in between to use different expiration dates. But unfortunately, at least using regular session data, we see our probability is 46.97 below 48%, which is our minimum. Okay, so I'm gonna switch to pre and post market, and we may get an improvement, and we did. Okay, so with pre and post market, we do get an improvement, which is 50%, and that's good because now we do have something to rely on when it comes to solid UFOs to set our statistical range and do a trade. Okay, now Novavax is not a stock with the most liquid options in the world. Okay, but the fact that it's there means that the scanner believes that maybe it's gonna be okay. I mean, at least there is open interest and things like that. So let's take a look and we will see. Mark, we don't have a rule where it says that implied volatility should be higher than 60%. No rule about that. So NVAX, okay, we have no rule about that, and unless I have a mistake on my scanner, there is no such a rule in the parameters. So when loading NVAX, okay, so notice that we have multiple expiration dates, okay, and that's good. Often when you see stocks that you expect them to be not so liquid, and again, how do I expect that? Well, it's out of market experience. How many times in your life you loaded NVAX charts? I don't know, very few in my case, okay, and therefore it means that I have not traded or traded very little that company, and if that's the case, probably it's because it's not a very liquid instrument. Because the ones that are very liquid, normally I'll be active on those ones. Okay, so it's just experience. Okay, but the fact that we see weekly expiration dates, it's a good sign. It may represent some liquidity. So let's take a look at January 21st. And it's not the most liquid in the world, but we are dealing here with 60 cents of spread, almost $1. Is not amazing. We should be able to see more liquidity on the monthly. We should. Let's see. So no, $1 plus, $1 plus. So yeah, so you know what? I'm just gonna pass because it's gonna be a huge pain on slippage if we do this trade. I mean, if we had nothing else and we were to really shave those spreads and we were to get a fill, so then we can take it. Okay. Sometimes, by the way, not so often. Okay, and typically for a few contracts only, but sometimes you do see those stocks that you don't expect them to be liquid, and precisely because they are not so liquid, sometimes market makers, they will just go ahead and shrink the spread big time just to get some volume in. Okay, maybe it was not a very high volume trading day, and towards the end of the day, maybe they will decide, you know what, let's narrow the spreads, right? And next thing you know, you get a fill. This could happen, right? And it does. Now, if it happens, it's not going to be like for too many contracts. Okay, so if you have a very large account and you want to get filled on 125 contracts, it's no way that you're going to get no slippage for that amount on a stock like this. Okay, so but just keep that in mind that sometimes you may get a surprise. Okay, so in this case, I'm just going to pass and look at IFF. And earnings are on February 10, so that's good. 45% is no good. So we're gonna move to regular session and see what we got. And we got 52%, which is good. Okay, it is good. My only problem is that I don't see any UFO below. I only see one. And remember, I need two UFOs above and two UFOs below. So why is it that I got no UFOs there? So let me load data starting in March last year. Okay, maybe I didn't load enough data. So let's do it manually. March 2020. Aha, yes, I do have more UFOs below. Okay, now they are very, very far away. And yeah, February 10 is not so far. So let's take a look. What was the stock again? IFF. So I'm just going to be a bit pragmatic here to save time. So February 10, it's prior to February 12. So the most I could use here is February 5. Okay. And what I'm going to do is, if I was to sell options below that UFO, which is, let's call it 99. So which one I would be selling on the put side? Let me see. Let's load everything. Oh, even if I load everything, I don't have the 99. The lowest I have is the 100. And if I was to sell the 100, it only pays me $25, which is not the 35 cents that I need. Okay. So no go on this particular case. It's good. The chart is good. 53%. It's actually very nice. But unfortunately, we don't have the UFOs near enough for us to accept the trade. Okay. Now about laboratories, let's see what we got here. So earnings are happening on April 15. So it means they happened not too long ago, and the next time they will happen, it's so far in time. So we got many Fridays that we can use. That's great. We got 53% probabilities. That is also very good. What if we look at pre and post market? We got 42%, so that's not valid. Okay, so therefore, if I was to do this trade, it would be using regular session data. Okay, now, again, problem, I only have one red UFO, so when looking at the daily time frame, notice that this is the peak that sets all times high for Abbott Laboratories. And what's going on? Well, the peak, starting from the peak, we only have one red UFO, so I simply cannot do a non-directional trade on Abbott because the rules we have are at least two UFOs above and at least two UFOs below. And we don't have that. Okay. So, later we could look and see if maybe a credit spread makes sense if we didn't have any trade on the non-directional section of the scanner. But certainly a non-directional trade on Abbott is not possible. We would break the rules if that was the case. Okay. Mark, but we want to sell options when AV is high, don't we? And buy options when AV is low. Yes, and the scanner is already taking care of that, Mark, because the scanner is looking at the top 50 options in the market that have the highest value when it comes to IV percentile in the implied volatility stock indicator. So by looking at those 50 more overpriced options, the scanner is doing the job. Okay, there are many different ways on how to assess options levels. This is indeed good enough. Well, it could be done differently, and it could be done in ways that are more complex and more precise even. But really, we don't need to be that precise with implied volatility for this type of trade. Okay, for other type of trades, that's a different story. Anyway, so FISV, we got 50%. Okay, we got 50%. That's good. And we got plenty of UFOs above and below. And earnings are happening on the 2nd of February. So if I look at the calendar, the 2nd of February is right there, meaning that I could go ahead and use the 29th of January as actually the only Friday expiration date I could use for that stock. But definitely that expiration date is there. And I got 50%. And what if I look at pre and post market? So that is 38. That's not good. So I would need to stick with regular session for that stock. And FISV. Okay, and let's go ahead and take a look at what happens if we use January 29. Okay, so liquidity is more or less okay, 169, 176, 139, 149. That's okay. So I'm just going to right click anywhere to analyze and sell an iron condor. When I say anywhere, it means that right now I don't care about the strikes. Right now I just care about moving the iron condor strategy into the analysis tab, because in the analysis tab, I have set up my parameters to be one standard deviation above and below. And because I have selected the date, even though I didn't select the strikes yet, it doesn't matter. So based on the date and based on the implied volatility built in those options, so it's saying that that stock got potential to go from 104 to 113 plus. So what I'm going to do now is go ahead and draw a line at 104, okay, which is more or less here. Okay, and then make it dotted, and I'm going to go ahead and draw a line at 113 something. Okay, I think it was something like that, right? So 104 something and 113 something. Here we go. Okay, and therefore those are the lines that are equal distance from the current price. Okay, this is current price. So this distance above is the same as this distance below. Okay, and basically those lines are telling me how far price should go starting from today until the expiration date on January 29. If things were to be normal, assuming or defining normal as the implied volatility built in the options contracts of that stock. Okay. Now that's very interesting, but that doesn't mean anything. Okay, unless we have UFOs. So what we want to do is that we want to pick UFOs beyond the dotted line. Okay, and that's the first one. But that would only be one UFO, so I'm gonna have to push the line to the second one. So now, if price was to go above, not only it's unlikely to surpass the dotted line, but now if it was to go beyond that, now it's going to hit those UFOs, and that should bring the price down, right? And if that brings the price down, even if in the end it goes, okay, well, at least is making that this is making a lot of time for us. And as long as we reach this date, okay, which is January 29, before February. So as long as the stock stays inside the range on that date, we don't really care that at some point it will go beyond the UFOs. We only care about the stock to remain in the range from now until the expiration date. So therefore, on the top part, we're going to pick that UFO, and on the bottom part, so this is UFO number 1, but it's not valid to be used as an extreme of the range because it's inside the dotted lines. This is UFO number 2. So even though it's the second UFO, and now we have the 2 UFOs we need, that one is still within the dotted lines. So I am forced to go for the next one, which is right here. And that one is indeed beyond the dotted lines, and because it's 2 or more, so that would set the bottom part of the range. And that's quite ideal as a setup. Okay, I'm not saying that we have a trade which is approved yet, but so far it's looking quite ideal, because if I measure the distance from the current price to my top part, right, and I project this same distance below, okay, so notice that there is, a little bit of an extra excess on the bottom part. I mean, if I was to use the next UFO, so then, not be balanced, the excess on the upper part will be humongous, okay? And, given the fact that the excess is just a little bit, I mean, in a perfect world, you would find the stock exactly in the middle part of the range. And certainly before we accept this trade, you could just make a note of FISV and keep going and look at AMD, PINS, Mendelez, and Snapchat. You can look at those companies, and if those give you a setup where price is exactly in the middle part of the range, take it. It's even better. But since we only got a few minutes to go, so I'm going to stick with FISV and look into putting a trade together for that stock, okay? And the way we will do it, now that we have the range which is defined and the stock is, more or less in the middle part of this range, as we said. So what we want to do is set up an iron condor, which would be made of buy a put and sell a put above the UFOs above. All of this, remember, we said it would be done using Jan-29, 2021 expiration date. And then below the green UFOs below, we will go ahead and sell a call and buy a call. I'm not sure what I'm thinking, guys. It's puts below and calls above. So I'm shocked at myself right now. Really incredible. I've done millions of iron condors in my life, and next thing you know, I'm typing it backwards. That's a funny one. I need to make a note and keep I'm gonna have a snippet of this video just to keep it, just to laugh. If any day I'm upset, I'm just gonna play this for myself because this is very funny to me. Anyway, so you sell calls above, you sell puts below, you buy calls above, and you buy puts below as well. The calls and puts you buy are for protection. The calls and puts you sell are the ones that give you the credit. And that way now you have your Iron Condor that pays you, assuming the stock stays in the range from now until the expiration date, which we said is on the 29 at 4 p.m. So in other words, we only need the stock to stick around inside the purple area. Doesn't matter if it goes up or down. We just need it to stay in the purple area from now until January 29, okay, which is, it's 1 week. It's a pretty active Iron Condor in this case, okay? Cool. So now, is that a valid trade? Well, again, let's begin with the top part. 117 is our reference. So let's take a look at how much we get paid if we sell the 117 calls. I'm very disappointed. Very, very disappointed. Only 10 cents. Yeah, I'm guessing 27% volatility for that stock. Out of curiosity, this is really, I was not expecting this. This is quite disappointing. What is the implied volatility for that stock? 21. Interesting. 21, and now it's 27. So 21, and now it's 27, which is more, and we only get 10 cents. My friends, something's going on in the prices of those options. Okay, when I see weird things like that, then my motivation is clear. I'm not gonna touch it. I'm not gonna even try. When you see something that doesn't make sense, it's basically someone knows something we don't know. Okay, so maybe the market makers are just doing something with the prices of those options because maybe there is something going on, maybe a potential merger. I have no idea what it is, but the fact is that we have more volatility than what the scanner saw, because TradeStation updates imply volatility at the end of the prior day, and the scanner uses that. So we got more volatility than what we expected, but we get basically zero premium, okay, by selling options at 117, which is not that far. It's not close, but it's not that far. So yeah, something's going on there. So I'm just going to move to the next one, AMD, and hopefully we'll have an opportunity to put a trade together here. So, well, earnings on the 26th, so that's not going to work. PINS. So let's see, earnings on February 4, that's good. Now, are we making all times high? We are. So again, we are depending greatly that we will find two UFOs on the screen. 47%, we will not accept that. So let me look at pre and post market to see. Not looking good, to be honest, but let's check. So waiting for data. Okay, 47%, no good. So we'll move to Mendelez Corporation. Earnings on the 28th, so that would not work. Snapshot, that's the last one. February 4, probabilities are good here with 49%. That's fine. That's with pre and post market. What if I look at regular session? That is 58, which is even better. Now we only have one red UFO, 5777 and 5577 is the same UFO. Okay, so we only have one, even though we have it in two charts, in the pre and post market as well as the regular session data, but it's the same one. Okay, so we cannot do a trade because of what we said before. So my friends, it's one of those days that happen, and you can, I mean, this is not the first time we see this. Okay, for the ones of you that have been around for a while, this happens from time to time, and you know. So I run the scanner before the market open, based on those picks. None of them is giving us an opportunity to trade. I thought we had it with FISV, but we didn't. So one thing you could do is go ahead and rerun the scan, and you may have a few opportunities that show up. Of course, the scanner is very highly sensitive when it comes to the prices of options. And as I said a minute ago, that is something that TradeStation updates once per day at the end of the trading day. So what we have now is the information related to yesterday, and that will not change even if I rerun the scan. So the probability of having new symbols, it's not so high. And if you do have new symbols, typically it would be just a few. Okay. So in other words, what I'm trying to say is that it's going to be a tough one today to get an iron condor in, and therefore the right action to be taken is to start looking at the other possibilities. Okay, for example, here we have Google, Zoom, Biogen, Apple. So again, we are about to surpass the time, but I'll take a look at Apple just so you see how I would do it, even though we'll have to do that the next day, but at least to kind of illustrate a bit. So you will look at Apple. Okay, you will want to see a decent probability, 54% right now. We don't know if it's going to be like that or not because it's still pending data. So let's wait. Okay. Well, actually, earnings are on the 27th. I thought it was the week after. So on the 27th, we cannot do it. Okay, because earnings are happening too soon. So I'm just going to move to, well, earlier we talked about Abbott. Okay, so let's look at Abbott. Abbott has the right probability, multiple UFOs, earnings in April. Okay, so you could go ahead and do a neutral trade, looking at those UFOs here and selling options below 100. Okay, so let's do it very quickly. So Abbott. Okay, I mean, I'm going to start with January 29, but that one is no way going to work. So I'm going to analyze and sell a vertical, and that tells me 106. So let me see how much I get paid for the 100 puts. They pay me 11 cents. So that's two closing time, February 5. The 100 puts pay me 20. Two closing time. So let's go for the monthlies on the 19. The 100 pays 54. So that could be valid. That could be valid. Okay, we may have a trade here with Abbott. Let's exploit it. So this is February 19. Okay, so I'm going to change the expiration date here to February 19. Okay, and this tells me, probabilities tell me that -1 standard deviation is 103.54. So in other words, this is not a non-directional trade. This is a neutral long. And what probability says is that based on probabilities, price should not go below 103 something from now until February, what was it? February 19. Okay. So price should stay above, okay, based on probabilities. Okay, now what's the beauty? The beauty is that if price was to go, okay, not sure why this is happening. So, okay, something interesting is happening here. So I'll don't do the drawing if that's okay. So if price was to drop from the current price and was to reach 103.22, so first of all, it's not likely for this to happen, but if it was to happen, it would then enter the UFO area and it would likely going to bounce and go back up. All of this is giving us time for us to go ahead and do a bull put spread made of selling the 100 put and buying 99 puts or something like that below. Okay, so the risk attached to this trade would be the difference between strikes. Okay, and the profit to be made would be the premium collected. Okay, so what are the rules and is it worth it or not? So first of all, let's look at the 100 put and how much we get paid. And here it shows that, okay, yeah, I cannot do it. So it shows that the 100 pays you 53 cents. Okay, so 53 cents, it's indeed more than what our rule suggests. Our rule suggests at least 35. So we got 53. Okay, and therefore, in the analysis tab, okay, you will now want to under sell -1. So you will want to select the strike to be 100. Okay, and we said that under 100 you got 99. So you would sell the 100 and buy the 99. Okay, that would be the idea. And if you do that, okay, so what happens? Well, what happens is actually not good. Okay, why? Because if you were to do that, based on what we see here, you would need to pay 40 cents. So it's not -40, it's +40. Okay, why is that? So if you do the 100, yeah, here's the problem. So if you do the 100, okay, notice how you got 46 to 59, okay? So it's not the narrowest spread ever, but it's okay. But then if you do the 99, notice that the ask price of the 99 is more than the bid price of the 100, okay, which is a fantastic arbitrage opportunity if you are a market maker. But for us, it's basically a slap on the face. We cannot do it because we end up being paid 52 and then we have to pay 59. So in other words, we would pay a debit instead of receiving a credit to do this trade. Okay. Now, what if we do the 98? Well, if we do the 98, it's looking like the liquidity it's better. Better in the sense that, we got 43 to 11, so the midpoint is 27. So if you compare the 52 you're gonna get with the 27 you would have to pay, you end up with a credit of 25 if I did the math correctly, and this may or may not be okay. We're gonna see that in a second, but that's better. Okay. In any case, I'm concerned about the fact that from 11 to 43, you got like 30 cents of spread there, which kind of like 30 cents of spread is kind of like the spread of the next strike, 34 to 40. That's only 6 cents of spread. So really, this is the ideal strike to be used if we were to do this trade. Unfortunately, if we were to use that strike, so we are widening the spread. Okay, so from 100 to 97.5, we are widening the spread. Oh, I got calls here, guys. Should be put. Sorry for that. Yeah. So let me go back to the prior one so you see it. Okay. So if you do 199, okay, it's not gonna be as bad as before. It's not 40 cents, but it's plus 5. Okay, plus 5. You have to pay 5. Okay. If I do the 97.5, so now we get paid 12 cents. Okay, so now we get a credit. Okay, what's the problem? Well, the problem in this case is that it's not going to work because the raw risk of the trade is 2.5, okay, which is the difference between, I cannot do the drawing, sorry for that. The difference between strikes is 2.5. So we want to take that 2.5 and we want to collect at least 15% of that, which is 38 cents. And unfortunately, we only get paid 12 cents. Okay, so that's the LDR strike to be taken out of liquidity parameters, as we saw on the chain. Unfortunately, we are not being paid enough. Okay, and definitely from 12 to 38 is like more than 3 times more. So I don't think it's going to work at all. So you will need to wait for that stock to fall. Okay, that would make it work. So if that stock was to fall, instead of negative 0.79, if it was to fall like 1-2% negative, not only would be closer to the 100, but on top of that, there would be a lot of scare coming in the market and the options would gain value. And that would potentially give you the opportunity to collect the premium you need. As of now, it's not going to work. Okay. I want to do one last thing before we go. If we do the 98, not going to work either. Okay. Because we saw the 98 was less liquid. Let's pretend liquidity is going to improve during the day. So your risk will be 2. You want to collect 15% of 2, that's 30 cents. And still, the midpoint is 24. Okay, so we are not receiving enough premium, and it's not like there is not premium enough because the strike that we sell, the 100, does pay us 48 now. Actually, it's losing value. I guess people are getting calmer on that stock, and options are losing value. Options are becoming less overpriced. But the problem really it's more about this value. The problem is more about that the strikes below are not having liquidity. Look at that, from 15 to 84. This is terrible liquidity. Even though the math tells you that, hey, you may get, actually now it's -1. Earlier it was -24. Okay, even though the math tells you that, the reality is that you don't want to do this trade because you could, let's say you are lucky enough to get filled and you're in the trade. And now let's say you have a risk management rule that tells you that when you get to half of the value of the premium, just close the spread and do another trade. Then you may not be able to exit because you would have lack of liquidity, especially as you are approaching expiration date. Some strikes will dry out of liquidity. So you may not be able to exit the trade, and now you are forced to wait all the way to January 29, which in this case is only 1 week. But as a principle on how to trade options, it's not a good idea to trade options that are lacking liquidity because you may not be able to get out and you are forced to wait all the way to expiration. Okay, which it's okay if it's part of your plan, but if it's not, then it's not okay at all. Okay. So, my friends, I said earlier in the session that what I appreciate the most is when I have many trades to be executed in the session, so you guys could practice a lot. So that helps you to learn, and then you can practice when we are not in the YouTube channel. But today is one of those days where, basically the lesson to be learned is how important it is to be patient. And if the rules are not met, you just keep looking. And tomorrow will be another day, or check again 2 hours later. But certainly we don't bend or break the rules to force a trade just because we want to be trading. Okay, not trading is trading. This is a very, very important lesson. It's critical. While it's difficult to understand, especially if you're new, it is indeed a very important lesson. And the ones of you who have some trading experience, I'm sure you could, I'm sure you agree 100% with me, because probably you're thinking about some of your trades that you took and you're like, why did I even take this trade, right? So this happened to everyone in learning stages, but I'm trying to shortcut the process of avoiding problems. So hopefully you're listening carefully to what I just said, because it's really important, and it's what you learn when you trade. Okay. Anyway, everyone, as always, my super pleasure to be running the session for you guys. Tomorrow we'll have Becky with stocks. Stocks trading. Sorry for that. I was thinking about multiple things at the same time. So don't miss it. Okay, a powerful session as well. And by the way, the trade opportunities that Becky defines with the stocks, you can then go ahead and convert them into options trades if you choose to. So instead of buying long or selling short shares, you can go ahead and do debit spreads, credit spreads, etc., etc. Okay. So, my friends, I will say bye now. You guys take care. Keep up the good work. Keep interacting with us. Shoot emails if you need us. And keep up the good work, everybody. Thanks for joining me. Take care and see you soon. Bye-bye, everybody.